A very good day to all of you guys. Hope you guys are doing well. Welcome to our fourth session in our combined series of classes, where we are now looking at Unit 10 of the syllabus, which is International Finance. Unit 10 of the syllabus. In the first three sessions that we did, we have completed in the combined series of classes for the 2024 advanced level batch. We have completed the 9th unit of the syllabus, which is international trade and related concepts. So today we are starting international finance. Hopefully you guys have the study material, and if not, you guys know what needs to be done to collect the study materials, right? And get this done properly. So I'll first give you guys more than anything just a brief understanding on what are the main areas we have to learn in unit 10 of the syllabus, right? We'll do that quickly and then I can start off, okay? So if you guys want to, you can make a note of these points that I'm giving. Maybe somewhere in page number 2, there might be some space for you. Yeah, in page 2. Right, if you have the study material, if not for now, maybe a notepad or a notebook that you have until you collect the original hard copy of the study material, right? That is issued by, published by Mind Ventures Econ-Hub. Okay, right. So in page 1 or in page 2, you guys can find some space. Okay, right. Page 1 also there is some space above that, below the heading, above the logo. If not, page 2. Okay, shall we then? Right. Please write. Right. Okay. Number 1. So these are, you can call them the chapters or the coverage, what we are going to look at. Okay. Number 1. Balance of payments within brackets, concept and application. Balance of payments, concept and application. Okay. Balance of payments, concept and the application. Done? Right. Then number 2. Reserve assets. Reserve assets. Okay. Within brackets, concept and application. Reserve assets. Foreign reserves. Okay. It's a bit of a important area, especially with the international financial situation that Sri Lanka is in. Okay. Reserve assets, foreign reserves, reserve assets, and within brackets you wrote concept and application. Number 3, third part, foreign exchange rates. Foreign exchange rates or forex rates, foreign exchange rate or rates. Okay, foreign exchange rates. Same 2 things within brackets. We learn the concept and the applications. Foreign exchange rates, concept and the applications. Number 4. Number 4. Please write. Multilateral. Number 4. Multilateral financial organizations. Multilateral financial organizations. Within brackets, mainly we will focus on IMF. Later on you will know the full meaning of those letters, no? You guys anyway know IMF, comma, or IMF and WBG, World Bank Group. WBG, World Bank Group. IMF and the World Bank. We have to know a bit of things about them, especially their objectives, functions, what facilities they offer, how Sri Lanka is dealing with them, those kinds of things. All of you know by now how important the IMF is, right? Right. So those are the main things we will be covering in Unit 10, 4 main areas. Okay? Right. So we'll start off with the BOP part. Okay? Right. So now I will share the study material initially with you, and then we will move on to the virtual whiteboard and get the job done. Right. So all of you have set yourself up properly and are fully focused to proactively get the job done. Learn international finance, starting with BOP. Right. So let me share the study material, which you will have the hard copy of now or in the future. Right. So as I scroll down, okay. Right. What is a balance of payment statement? What is a balance of payment statement? Is the first area. Obviously, we have to have a simple working understanding of the balance of payment statement. So I've given a small, I wouldn't necessarily call it a definition, but something you have to know how to explain a BOP. So it says a balance of payment statement is first and foremost, it is a statistical statement. So it has a bunch of numbers in it. Okay. That give us an idea about a record of our international economic transactions or our economic transactions with the rest of the world. Economic transactions. Sorry. Is this okay? I think by mistake someone has got their microphone unmuted. I think we're okay now, right? Yeah. Okay. So as I was saying, right? So international, economic transactions or economic activities is a better word that we engage with the ROW, rest of the world. Okay. So statistical statement, which is a summary of summarizes all legal, that part is important. Okay. Because there can be a lot of illegal underground things we do, right? Individuals do with the rest of the world. Illegal economic transactions and transfers. So if I use one word for both transactions and transfers, I could say economic activities. Economic activities performed by a given country. So the residents of, for example, Sri Lanka with the rest of the world, ROW, non-residents. Right? Now, this can be done officially. That is, right? We can say G to G, government to government, right? Or government to G to B, a business in another country, but still it's official because who is getting involved? Government is getting involved. Or it could be done privately. So then that is basically it could be business to business, B to B, or it could be maybe an individual, so I could say I or H, a household with another individual, or an individual with another business in another country. So all of these possibilities are there. So how do we say it? Officially and privately during a given financial year. During a given financial year. So when it comes to the financial year for your exam, it will be 2022. That is more relevant to us. And 2022, as you guys know, right? is extremely relevant to Sri Lanka as a country as well. We know why, right? Okay, right. Then what I want you guys to do is just to get an idea of the balance of payment statement. We have to understand this is a statement that is in principle prepared based on the guidelines given by the International Monetary Fund, IMF. They prepare a special manual for their member countries to follow. A book, right? A series of volumes are there that member countries should follow when they prepare the BOP, balance of payments statements. Actually, those manuals explain the entire set of foreign accounts a country should prepare and how they should prepare them, how they should treat the different entries and all that. And they follow the, or we follow rather, the accounting double entry system, accounting double entry principle is followed. Okay, accounting double entry system or the principle is followed. Is that clear? Right. So we'll make sure that we are talking about these statements according to the guidelines given by the IMF, because that is what your examiners will expect from you when you go to the exam also, right? So a small note I want to give on that. So we'll quickly write. I'll go to the virtual whiteboard, right? So yeah, all of you can see this on the screen now, I'm sure. Right. Okay. So this is the small part. The first part is there. Now you can see. Can you just quickly make a note of that, please? You don't need to have this, thought bubble or whatever, right? You can just write it down. Get it done quickly. Okay, so clearly we are saying economic activities recorded in the balance of payment statement are based on the accounting double entry principle or system. And then we are also indicating very clearly, right, that a basic thing, right? We will talk more about this and I will teach you, I will share with you a very simple technique we follow, right? You don't need to go into double entries as much as you go into accounting. Okay, it's a basic, a technique we follow, that's it. But any inflows, right? The main example is the exports. Any inflows of foreign currency that comes into Sri Lanka through our international economic activities is a credit into the balance of payment statement. Any outflows, mainly through imports, is a debit in the balance of payment statement. Get it? Right. So with that, we look at now. If you take a company, right? If you take a business, in accounting, you guys learn they prepare a set of accounts, right? What are the main accounting statements that should include in a company's set of accounts that show us the performance of that company for that given financial year? What are the main types of accounts should be there in a company's accounting statements? If you can make your accounting teachers proud. Okay. One of your classmates is asking, yes, but I said the second point in blue color, and I said you don't need to have a thought bubble like this, but just make a note of it. Okay, right. Okay, let's see. Okay, so I'm getting a lot of abbreviations and also many statements, right? Definitely, it seems that you guys are not discriminating against accounting. Right. Okay. So, good. So, basic idea is we have generally, right, three main things we look at to know the financial health of the business, performance of the business. We will look at the simply said the income statement, but I think now you all call it the statement of comprehensive income or something like that, right? Then we will look at the balance sheet or the statement of financial position, and we also need to understand the cash flow situation. So we look at a cash flow statement. Similarly, as a country, to know our performance, know our financial position, when we deal with the rest of the world, we prepare what we call a set of foreign accounts. What are they called? A set of foreign accounts. In your study material, I mentioned this. What are these foreign accounts we prepare? You can see the study material now on the screen. You have it physically also. So we prepare mainly. So that part about the balance of payment manual. Okay. I explained earlier. So we are using the 6th edition now, which was published in 2009. And the balance of payment manual is published by the International Monetary Fund, the IMF, our friends. Okay. Who is more or less now acting as our big brother. Okay. Right. International account statements include three things. One is the balance of payment statement. Okay. One is the balance of payment statement. BPM. Okay. The concentrate most of the things I am saying. What did I say? IMF prepares a balance of payment manual. So the abbreviation we use, okay, I understand it's confusing, is BPM. Balance of payment manual is called what? BPM. Okay, it's a series of books with several volumes where in detail they explain how to prepare the international account statements and especially the balance of payment statement, because it's a very complicated thing. And the IMF says if different countries or if each country prepares their balance of payment statement in different ways, following different treatments for the entries, every country will follow the double entry system, but still, there is a each economic activity we need to have the same treatment. Okay. So if each country does that, okay, if each country does that, the end result is, are you guys with me? Can hear? Yes. Yes or no? Right. If each country follows a different methodology, what will happen is the BOP outcomes, that is the current trade balance, current account balance, then the overall BOP situation, and from that resulting the foreign reserve situation, all these things we can compare. So we don't have a comparison, and we don't know relatively or comparatively how well or how bad we are doing. So to facilitate international comparison and to treat all the member countries of the IMF in the same way, IMF has introduced the balance of payment manual. All countries prepare it the same way now. Okay, right. Then, so what are these three things that we include in a company? We talked about the income statement, balance sheet, and the cash flow statement. Likewise, for a country, for international finances, we prepare three types of accounts included in our international or foreign accounts. Okay. BOP statement. Why it is highlighted is in your syllabus, we will mainly learn about the balance of payment statement. In that also, the current account is what we deeply learn about. Then, in addition to that, we prepare international investment position statement and other changes in financial assets and liabilities. Now, this other changes in financial assets and liabilities, this becomes a bit important to us when we try to estimate something called the overall balance of the BOP. When we estimate the overall balance of the BOP in the new BPM 6th edition, we use a separate statement for that. So there I will talk about that a bit, but mainly we focus on the BOP. Right. Then your professor says there are 5 broad, right? There are 5 broad types of transactions. He uses the word transactions here, but we actually have transfers also. Transactions included in the balance of payment statement. 5 categories. First one, basically imports and exports of goods and services. Very simple. Secondly, transactions pertaining to income. So this is basically primary income. What income? Primary income. Remember we learned in Unit 5, primary income, right? Factor-based income, right? Then that is the second item. Third item, unilateral transactions. This is what I called transfers. Both current nature and capital nature we include. Okay, unilateral. So number 3. Number 4, we have non-financial, non-produced assets. This is what we talk about in the capital account of the balance of payment. Non-produced, non-financial assets. So that's number 4. And number 5, financial assets. So this is what we talk about in the financial account. Okay, this is in the capital account. We will look at the structure of the BOP next. So then you will get an idea of this. So 5 types of transactions that we include in a country's balance of payment statements. Don't get this mixed up with these are not the 5 accounts or anything like that. But broadly, all the activities, all the things we include record in the BOP fall into 5 categories. Goods and services, imports, exports, income, primary income, inflows, outflows, unilateral or transfer related things, then non-produced, non-financial or capital account related activities, financial account related activities. Okay, right. Yes, one of your classmates has asked a question. But now in your syllabus, I'm sure wherever you have studied up to this point, you have learned this. In your syllabus, it's very simple. Unit 1 is introduction. Okay. Unit 2, 3, 4, 2, 3, and 4 are microeconomics. Unit 5 onwards up to Unit 12. Unit 5 to Unit 12, it's macroeconomics. Okay. Right. Then, okay, main components of the BOP statement. Now, this is going to be an important note for you. So, I want you guys to take all effort to really concentrate and write everything you need to write, everything you think is important for you to know in this page, in this area. Are we clear? In which format you write it, you can decide. If you want to divide the space vertically and create more space for yourself and do this, that's also okay. That's up to you. But make it a very complete note for you where when you look at it, you would know exactly the format, the structure of the balance of payment statement. What are the main accounts? What are the sub accounts? And all that. Get it? Right. So I'm sure you will get it done properly with concentration. Right. So, I'll go to the virtual whiteboard, the slides for this. Right. So first, we'll start off with the main accounts. There are three main accounts in the balance of payment statement in terms of accounts. What are they? Current account. You guys can wait. If you want to, you can wait for me to bring this whole thing on to the virtual whiteboard. Then you can start writing if that is more comfortable. Right. Current account. Three accounts, current account. So remember the number 3. Okay, in terms of accounts, right, there are 3. Current, capital, and financial. Current, capital, and financial. When we prepare the balance of payment statement, current account and capital account goes together. Current account and capital account goes together. But 3 separate accounts are there, right? Then there are few items that we include in the balance of payment statement. In addition to the 3 accounts, we have something called a very important item called errors and omissions. It's a balancing item. This is called a balancing item. Okay, errors and omissions. Errors and omissions. Then we have a component called overall balance. Like in some accounting statements, you have this bottom line of the profit, net profit, the net loss, likewise, overall balance. So these I call them, what did I say? They are components. So all 5 can be components. So we'll say 3 accounts. So in terms of components, right? I'll say components. We have 5. Out of that, 3 accounts, and in terms of special items, we have 2. So that's a breakdown. Okay, right. I said whatever that will help your knowledge, up to you. Once you start writing, get that done. Then if you take the current account, it has current account, right? The current account, we'll call it that, has 4 sub-accounts. That's a number to remember, 4. What are the 4 sub-accounts of the current account? We have the trade account, sometimes called goods or merchandise account. We have the services account, sometimes called trade in services account. Then we have the primary income account and the secondary income account. So there are 2 income accounts, no? Primary income and secondary income, right? So these are the subcomponents of the current account of the balance of payment statement. Then I think you guys will have space for this. I have given this in page 6 also, but no need to write it here. Listen, no need to write it here. If you think you can do it quickly, I don't mind you guys making a note of this. This noteworthy part, but in page 6, if you have the hard copy of the study material, just go and see. Bottom of page 6, I have given these formulas. Okay, so you make a decision on that, but I have to explain it quickly. The idea, I've given it in page 6 because by the time we get to page 6, we have fully completed the current account. Then you have a better idea. But for now, I'll just quickly say this. There's a link between the national accounting calculations we do, especially in the income approach, especially in the expenditure approach, right? So this connects to the NAP, National Accounting Process, expenditure approach. Okay, we've done a very comprehensive discussion on unit 5 and 6, no? Right? You still, I think we have made the recorded versions also available for the theory students. So NAP, National Accounting Process, expenditure approach, if you guys remember, I'm sure you remember because we did a comprehensive job there. We have the items like net exports, primary income, So sorry, net property income from abroad. No, these are the expenditure approach related concepts are these, no? Net exports, then net primary income from rest of the world. You guys remember we talked about something called NFCT, no? NFCT, when we want to convert GNI to disposable GNI, what we use? Net primary income, when we want to convert. Are you clear on the conversions we use these for? Can someone tell me what are the conversions? This is used to convert a concept called GDE, gross domestic expenditure, into what? GDE into what? Unit 5 this is, not unit 10. Net exports is used for what purpose? In the expenditure approach. To convert GDE to, come on. Okay. We did a comprehensive job of unit 5, all three approaches, in output, income and expenditure, and the recordings are available. So you can't give an excuse, zero excuse, right? Yes, very good. Good number of you guys have responded very quickly. I'm very happy to see that. GDE into GDP, very good, right? What do we use NPI, net primary income, for? To convert GDP into what? Let's see. Very good. There we go. Yes, I'm getting answers at a good rate. That's good. GNI, gross national income. When do we use NFCT? I gave an idea earlier. NFCT, to take GNI and convert it to what, Pudha? Disposable gross national income or gross national disposable income. So now we see a link between these expenditure approach conversion factors, items, and the balance of payment current account. Balance of payment current account. That knowledge is important to have. There's a big discussion, right? In your examiner's text, there's a big, about two or 2.5 pages of a discussion on these, all the links. But okay. I think you can trust me when I say what I have given is enough when you go to the exam. I think what I'm saying comes from a good background of, or good pedigree of trust. Okay, right. So, right. Make it simple. Remember these three formulas and the link. Okay, right. Yeah, why don't you guys get this done? And let me know once you're done. Are we done? Yes. Right. Now, while we have explained the current account and the sub accounts, we have to go a bit more into detail about the capital and the financial account as well. Remember, three main accounts. So, capital and financial account, especially the capital account, we have two ways that we include things in the capital account. We have capital account credits and we have capital account debits. Capital account credit is basically the disposal items and the debits are the acquisition items when we buy. And also maybe you can I move to the next slide, please? Do I have permission to move to the next slide quickly? Can you guys let me know? Right. Most of you guys seem to be okay. So I'm going to move to the next slide. Right. Continued the main components here. This is where now capital account fundamentally is where we have, remember, non-produced and then non-financial. Can someone tell me, we have used this phrase before, non-produced, non-financial. Before we have said it somewhere. We have read it somewhere. We have learned it somewhere. Where was it? Non-produced, non-financial. Do you guys remember? We have discussed about non-produced, non-financial somewhere before. Can someone recall? You within the last few minutes, you did recall this earlier for a different area. Vishwa Tulasi. I think I said it correctly. Brilliant. Very good, Buddha. Yeah. Shrilisha, yes. Your unit is correct. Yes. Ajay, yes. Broadly, the area is correct. Okay. Yes, we learned this. We used this term when we were describing gross fixed capital formulation. Okay. Gross fixed capital formulation, which comes under investment, gross capital formulation in unit 5 in the expenditure approach. Yes. There we go. Yes. So front correct. Yes. Got it? Right. So that is what we have in the capital account. We record it. The disposal of non-produced, non-financial, we give it as a credit. Acquisition of non-produced, non-financial, we give it as a debit item. Is that clear? Right. So capital, there are no special accounts to remember, but keep this non-produced, non-financial thing in mind and the debit credits are easy. Right. Then financial account. Financial account, yeah, we know that no need to make a note or anything. Capital account is grouped with the current account when we prepare the statement. Financial account. Okay. First thing I want to say is financial account, the components, or someone could call them the sub accounts, items, whatever it is, right? I'll call them the sub items. I feel that's a good term, right? Sub items 5. Remember the number 5. Okay, remember the number 5. How do you break it down? This 5 is, a breakdown of the 5 is 3 plus 2. 3 plus 2. The 3 is investments. 3 types of investments. What are 3 types of investments? It's very easy to remember it this way. We have direct investment, 1. portfolio investment, 2, other investment, 3. Direct portfolio, other. 3 types of investments are there. Then the remaining 2 items are financial derivatives. That's a word to keep in mind, derivatives. And reserve assets. The thing we are going to talk about separately, reserve assets. So how many items? 5 items. 3 plus 2. 3 types of investments. Direct, portfolio, other. Derivatives, reserve assets. 5 items are there. No need to sing a song about it. You can remember easily. Are we clear? Right. That completes the main accounts and the sub items that come under the 3 main accounts. 3 accounts. But don't forget, there are 2 special items we talked about. Do you remember? That is also there. That is errors and omissions. You have written that. Errors and omissions and overall balance. Right. So now you guys should be able to give a pretty comprehensive layout of the BOP statement, right? Pretty comprehensive layout of the BOP statement. If you can do this with me once, I would appreciate it. We'll do this about twice or thrice during the learning process. Okay. Can you guys, if you don't mind, keep a pen or pencil like what I'm doing with the styler that I have, the pen. Okay, done. Just do that. My pen is running all over the place. Right, done. Good. Now, can you just concentrate and look at the screen, even though I don't see you guys. I'm going to believe that you're doing what I'm asking you to do. Right. We are going to quickly go through the entire BOP statement outline. Right. So, how many accounts? 3 accounts. You're doing this with me. Okay. How many accounts? 3 accounts. What are they? Current, capital, financial. 2 special items. What are they? Errors and omissions, overall balance. Current account has how many sub-accounts? Current account has 4 sub-accounts. What are they? Trade account. Just use that term for now. Trade account. Services account. 2 income accounts are there. Primary income and secondary income. Primary income and secondary income. 4. Done. Capital account. What do we mainly record? Capital account, we mainly record non-produced, non-financial items. Credits are the disposals. Debits are the acquisitions. Okay? Right. But mainly remember non-produced, non-financial in the capital account. Also remember, capital account is grouped together with the current account. Done. Then we come to the financial account. What account? Financial account. How many items? Sub-items? 5 sub-items in the financial account. How do we break it down? 3 plus 2. 3 investments and 2 items. What are the 3 types of investments? Direct, portfolio, other. 3 plus 2. Derivatives, reserve assets. Derivatives, reserve assets. Got it? That's your BOP statement. Just for knowing that, you get marks sometimes. Get it? Right. Good. So with that, we move on to a discussion on the current account. That's what we're going to do next. Okay. So we start with, in page number 5, the current account of the BOP statement. Okay. Right. So here we go. The current account of the BOP statement, mainly we include activities of a recurrent nature, reoccurring during the given financial year. They keep taking place. Recurrent, reoccurring or recurrent are the words. Right. So I explained them. Then 4 sub-accounts are there. And the outcome is called the current account balance or the balance on current account. Current account balance or the balance on current account. Remember in Sri Lanka, since we learned this with Unit 9, since 1977, right? Since 1977, we have had this liberal, full current account convertibility is there. So full current account convertibility. That means we have free and liberal manner. We can engage in international trade on items connected to the current account. Imports, exports, primary, secondary, those things, especially trade. Especially what? Trade. Free and liberal manner. Trade can take place. Normally, when we say trade, Putta, we talk about X and M of mainly goods and then services. Can you tell me what this means? So, we can engage in current account related international trade in a free and liberal manner in Sri Lanka because we are an open economy, especially for international trade. So when we say trade, we mean exports and imports of goods, mainly goods and services. Is that clear? Right. Then trade or goods merchandise account. So what I want to do is we're going to go through a list of items. We'll quickly write them. Then we will touch on them because we have learned these things in Unit 9. We can do this a bit quickly. Okay. Anyone who was not there, who was not able to join the live sessions for Unit 9? And so what you need to do is put up parallelly as we are doing Unit 10. If you're joining the live session for Unit 10 as we're doing it, quickly look at the videos, the recorded version and get Unit 9 balance, get it covered. Okay? Right. Especially the last part, the fourth chapter of Unit 9 is a bit important. Okay? Right. Yeah, all these things I touched on in the explanation I gave. Right. Can you write this in page 5 where it says trade goods merchandise account? Quickly write this. Right, done. So in unit 9, when we learned about our import-export structure, we fundamentally learned the main items, right? But before that, something that needs to really be captured by you is the trade account only includes, okay? The trade account only includes either we say physical or visible. If not, one more term is tangible. If not, what is the word? Tangible, physical, visible, or tangible. You don't have to say all the words, but that dimension is there. Tangible goods. So export structure. So can you show me the BOP statement note, page 3? Yeah. Yeah, but now that we have moved forward, I okay, I can't go back now, okay, because it's not fair for the class. Just see if you can maybe use the recorded version for that, or after the break, if you can remind me before I start, I'll quickly go to that. Okay, right. So we have right. We have exports, agricultural exports, industrial exports, and mineral. For each, I have given the main item. Sri Lanka's main agro export item is tea, industrial apparels, garments, textiles, gems for mineral. Done? Right. Imports. We are looking at consumer intermediate investment. Consumer intermediate investment. Consumer, we are looking at mainly food, non-food items, right? So today it's non-food is a bigger item because of medicine and things like that. Then intermediate, mainly petroleum products that we need, petrol, diesel, all that, textile items. Then investment is machinery. Investment is machinery, main items. There are other things also. Right. Then we have a special thing. In the BPM 6th edition, right? In the trade account, in addition to the standard export import items of physical, visible, tangible goods, we talk about a special thing called non-monetary goal. So there is monetary goal and non-monetary goal. What is non-monetary goal? Okay, so you have to have an idea. And remember, non-monetary gold comes as a special item under the trade account. Non-monetary gold comes as a special item under the trade account. What is non-monetary gold? So I've given this note for you guys in page 5, nothing to write, but quickly we'll understand. It says gold stock used by gold industry, goldsmiths, to make items such as, right? Now, this is the gold stock. Sometimes you get confused and think it is the jewelry that people have. No, the gold stock, who has? The gold industry has, goldsmiths have, to make items such as, jewelry, dental implants, right? Then machine components, etc. And gold used by private sector as a store of value. So, gold stock of the industrial sector and the gold stock of the individuals, but where you keep it as a store of value, an investment asset, store of value. Gold trading. Now, are we clear on what is non-monetary gold? Because the monetary gold is only kept by central banks. That is, central banks around the world, part of their reserve assets, listen carefully a bit, central banks around the world, part of their reserve assets, they keep in gold. Gold bricks, blocks, they keep, right? The reason, now why would a central bank want to keep gold? Central bank doesn't make jewelry, no. Central bank doesn't make dental implants. Central bank doesn't make machine components. Then why on earth is a central bank keeping gold with them? It's a way to diversify their reserve assets. Gold is seen as a safe haven investment. I'll repeat, gold is seen as a safe haven investment. You understand? Gold is, if you invest in gold, there's a bit of a stability there. The reason is, over a period of, yes, gold prices in the world market, in the bullion exchanges of the world, gold prices will fluctuate, increase and decrease, increase and decrease. But over a period of time, gold always, because it's a precious metal, always the value will what? Appreciate. Always the value will appreciate. 5 years before, 10 years before, and now gold prices have appreciated. They will, with market changes, prices will go up and down. That's true. Fluctuations are there. But overall, gold prices keep appreciating. So gold is seen as a good way to diversify the central bank's reserve assets, and it's a safe haven asset. So central banks maintain gold reserves. Gold reserves. That is called, listen, gold maintained by the central bank of a country as a reserve asset is called monetary gold. What gold? Monetary gold. Then we are talking now about non-monetary gold. Non-monetary gold. Non-monetary gold is the gold kept by, number one, gold stocks of the gold industry, goldsmiths, people who make things out of gold. And secondly, the private sector, your parents or whoever, if they have invested a bit in gold, there's a way to invest in gold also, but that's the second part I will explain. So if you have invested in gold as a store of value, store of wealth, then that is non-monetary gold, right? So how does this work? Gold trading, buying and selling, implies a change in, now that's important. People think this gold trading means actually like buying a good or item or something like that. Yes, gold trading is different from buying a vehicle. When you buy a vehicle, you pay, and when you buy the vehicle, you have the vehicle, you get the vehicle. Get it? But in gold trading, it is not, you don't get that gold to your hand. It is a stock of gold somewhere. It is actually there, but it's a stock of gold kept. It's not new gold also. It's the same, certain amount of stock of gold is kept to the, and the ownership of that amount of gold is bought and sold. Ownership is bought and sold. So I've explained it here. Implies a change in ownership. It's only a change in ownership of the gold stock, through an account system centralized through international bullion exchange or bullion trading centers, especially very popular one is Singapore Bullion Exchange. So in the Singapore Bullion Exchange, like the Colombo Stock Exchange, in the Singapore Bullion Exchange, you can open an account. And what you can do is, they will list a certain amount of stock of gold they have. That gold broken down into units, people can buy and sell. People can buy and sell. So it says an actual shipping or physical movement. Actual shipping or physical movement will not happen. The gold you invested or the gold you bought doesn't come from Singapore to you. Get what I'm saying? It's in Singapore. Gold is there, but what you have is the ownership of that gold, certain amount of gold. And this is not new gold also. It's a stock of gold where the value is determined and then the ownership is bought and sold, is traded. But the existing stock at the point of time, whatever the existing stock is, bought and sold. You can introduce new gold in the exchange, in the bullion exchange, but what we buy and sell is not always new gold, right? So when someone says I have invested in gold in the Singapore Bullion Exchange, that doesn't mean they have bought new gold is being added there. They have bought the ownership of the existing stock of gold. This makes non-monetary gold unique from other tangible goods. Like the example I used with the car. When you buy a car, you get the car to your hand. But here, you only have the ownership of it. You have the ownership of it. You don't get the tangible item. Non-monetary gold is related transactions are recorded separately. That's important. Some people don't get that into their head. Separately within the trade or merchandise account. Within the trade or merchandise account. Any questions on non-monetary gold? No? We are okay? Right. Services account. Yes, there's a question. So is it like buying shares? Yep, something similar. True. Okay, something similar. True, but the difference between this non-monetary gold and shares is in shares there is no tangible element to it at all. It's financial. But here there is a tangible element. There is actual gold is there, but it's not shipped, it's not moving, but you get the ownership of it. Is that clear, brother? Yeah, that's right. Okay, good. Invisible or non-factor services. So what are the other words? Invisible, intangible, those can be used. Invisible, intangible, non-factor, not factor-based services, not primary incomes, non-factor services. Right. Quickly write these items, please. Hold on. In the slide, it was in blue color. So I came to the conclusion that we have to write it. But as you guys are pointing out, yes, we're wasting our time. It's printed and given. Yes, sorry for that. So let's quickly go through. And also I've improved the note by including words like intangible also. Right? Good. Then, so what do we have for the transport, travel, telecommunication, computer and information services, construction services, the consultancy, things like those, okay? Designing of drafting, designing models and buildings, plans and all those kinds of things. Insurance services, pension services, financial services is in bold lettering because it's a new item that come from the BPM 6th edition, financial services, government purchases and other business services, government purchasing services and other business services. So one major item that we have here under travel is tourism. If you want to near the word travel, you can include tourism. Tourism is a big service related item in Sri Lanka, as you guys know, tourism. Right. So this is what we have in the service account. There are receipts and payments, service receipts, service payments, and we get a balance for the services account. Right. Okay, these are additional things. Then we come to primary income account, which is also basically factor-based services, primary income account. So I've explained it a bit more in detail for you. There's a special item. Sometimes that item is misunderstood. So I thought of explaining it a bit. Compensation of employees. Normally, when we say compensation of employees, it's any kind of payment done to parties providing labor, their physical mental effort. But here, when we say compensation of employees, The idea is a bit different. The idea is more specific, right? Now, read this with me once. And we have talked about this in the expenditure approach also, Buddha. But just to be clear, income earned by, mostly we are talking about whom? Income earned by, mostly we are talking about professionals. Professionals by providing skills in foreign countries. But it has to be what term? Short-term contracts without losing their residency. They don't become non-residents. They're still residents of Sri Lanka. But they visit, go to another country, offer their services, and for that, they are paid. Get it? An employment income of parties residentially employed in diplomatic missions in foreign countries. Is that part clear or not? First part, I'm sure is very clear, right? Where Sri Lankan professionals go to foreign countries for short-term assignments, contracts, provide their services, their skills, earn something and bring it back to Sri Lanka without losing their residency status. Okay? Without staying outside of the country for a period more than a year, they come back, so they are okay. Then, so they are still residents. Second part, did you understand? Employment income. So we are taking under compensation of employees, employment income of parties residentially employed in diplomatic missions in foreign countries. Sri Lankans working in the Sri Lankan embassies, right? Sri Lankans working in Sri Lankan embassies in foreign countries. You understand what I'm saying? So, sorry, what am I saying? So yeah, Sri Lankans who are working in embassies of foreign countries. You understand my point? Sri Lankans who are working in embassies of a foreign country. Then Buddha, what they are paid is paid by that foreign country. No? Whatever they are paid, it is paid by that foreign country. So that is a compensation of employees in compensation of employee or in employment income they are getting, even though they are in Sri Lanka. They are getting that income from that of a foreign country. Is that clear? Are you clear or not? Okay, that is the meaning for compensation of employees. Now I'm confused. So this is already printed. That is, I think you all said it for the earlier thing, right? Yeah, I didn't ask you to write this, but this part I'm just going through the note. Are we clear? Yes. So one of your classmates is asking the country that's employing them. Yes, it is the country that is because now we'll say that UK has a high commission in Sri Lanka, the British High Commission in Sri Lanka. Basically, Buddha, if someone is working for the British High Commission of Sri Lanka, okay, that means they are part of, they are paid by the British government. And actually, when you go into the British High Commission in Colombo, down Bullis Road, right? If you go to the British High Commission in Colombo, the moment you enter the High Commission premises, you are no longer legally in Sri Lanka. Physically, you are in Sri Lanka, but legally, you are not in Sri Lanka because the British High Commission is part of the government of Britain. You are in Britain, even though you are in Bullis Road, down Baudalagamavat. Is that clear? So, you understand the salary paid to you by the British government is where you are basically offering your skills and services to a foreign country and they are paying you. And they are paying you. Right. I think you guys are clear. What are the other items we have under primary income? Earnings from investments by direct investment enterprises, DIEs, interest payments on external debt, especially, my God, especially ISBs, international sovereign bonds. Now, these are what we are not paying. We have defaulted, but the payments on these is recorded in this account. Then profits and dividends. Profits and dividends. So interest payment is a big item now, right? Even though we haven't paid to our ISB holders interest or anything in return, but it is a big item in the primary income account. Then for the investments, then items such as rental income, then income from non-produce, non-financial returns you get, then other interest incomes and tax subsidies on production, imports, all of those things related to primary income. Main items have highlighted, and you have to remember most of these items. It's good if you do, but a simple way to remember is we can say we have CE, compensation of employees, and these could be seen as IPDs. What is IPDs? Someone could tell me. I use this in Unit 5 also. IPD. C is compensation of employees. What is IPD? Anyone? What is IPD? Interest, profits, and dividends. IPDs. Then it's easy to remember. Okay? Right. Very good. Comedy, very good. Right. Then secondary income. What do we have in the secondary income account? Biggest item. Now, first of all, secondary income is in unilateral transfers, one-sided things. They are not transactions. Okay? Private official. Biggest item is migrant worker remittances. Biggest item is migrant worker remittances. Okay, there's a question from one of your classmates. What are sovereign bonds? Is it like selling securities by the government to other countries? Other governments? No. Not to other governments. Private investors. Yes, government of Sri Lanka has since 2007 up to now we have issued many ISBs, international sovereign bonds. That's how we find the money we need to basically engage in certain development and other activities we have, and also simply to cover our trade deficit and the foreign currency requirements we have. All that when we have a shortfall, we have got into the habit of issuing ISBs, international sovereign bonds. So approximately about 12 billion US dollars worth of ISBs now we have defaulted. We have to repay, and now we are negotiating with a huge number of individual investors, investment companies, private sector that has invested in our ISBs. They are called bond holders. They are called bond holders. So they are putting a lot of pressure on the government of Sri Lanka to repay their investment, and we are trying to negotiate with them and to restructure those loans. So ISBs are, yes, a type of government security, dollar-denominated government security that is issued to raise funds for different government activities. We will learn more on what are ISBs in two places, mainly in Unit 8, Public Finance. Got it? Right. Then, worker remittances, migrant worker remittances. That is, Sri Lankans who are working abroad, sending money back to Sri Lanka, is after exports our biggest foreign currency inflow. I'll repeat, after exports, our biggest foreign currency inflow comes from worker remittances. Worker remittances. Sri Lankans sending money back to our country for their dependents. That's one major inflow of foreign currency for the country. Then other private transfers are there, current official transfers, government transfers, the different donations and we get on a current basis, not the long-term things, right? We record here. So I've given that noteworthy part again because we have completed the current account. I thought it's good to remind you the link between the net exports, NPI, NFCT, and the current account balances. Right. Page 7, we start capital account of the balance of payment. Okay. The capital account of the balance of payment. Now, okay, we started late, so I am thinking of taking the break also a bit late. Do you need it now or can we go a bit further? I will take the lack of response as you want to go a bit further. Some of you guys are saying break. What do you think? Excellent. Some of you guys are saying go a bit further. Some of you guys are saying break. Okay. Since this is a good place to break because we are completing current account, then we have to start the capital account, right? Yeah, I'm going to take the break now. And after the break, we are going to get into the capital account. And I want to finish the BOP, the introduction part definitely today. And try to get into the double entry part also. I think we can get all that done. Okay, right. So let's get back after the break ASAP. Welcome back after the break. So we are now continuing our discussion into the capital account of the balance of payment statement. And along with the capital account, we will talk about the financial account. Right. So in page 7 of your study material, I have explained, given a basic explanation about the capital account of the balance of payment statement. So the capital account includes mainly changes that take place in the ownership and the rights of change in the ownership and rights of, or we use words like acquisition and disposal. When we sell, disposal. When we buy, acquisition of non-financial, non-produced assets. In addition to that, we have an item called capital transfers. We have an item called capital transfers. In Sri Lanka's balance of payment statement in the capital account, mainly what we have is capital transfers. We don't have major items that come under acquisition and disposal of non-financial, non-produce. Mostly we have official capital transfers. That is the different long-term project donations received by the government of Sri Lanka. Okay. Right. I mentioned that as well. Right. Then, so private capital transfers, the net value we take. Then we have official capital transfers, the net value we take. Again, mainly what we have is official capital transfers. This is the main item we have. But conceptually, you guys need to be updated on this. You need to have the knowledge. So essentially, what do we have? Acquisitions, disposal of, many times we have said this, non-produced, non-financial assets. They could be in tangible and intangible form. Intangible but non-produced. Remember, tangible but non-produced. Land, mineral, quarrying resources. This is basically the mining rights, the right to use those resources, the licenses, the permits, things like that. That is what we are talking about, right? Under tangible items. Are you guys with me? Right. Then intangible, we have things like royalties, copyrights, patent rights, brand names, things like that. Okay, these are all things that are non-produced, non-financial, where you can now, for example, these sometimes franchise kind of agreements, things like that, all can be captured here. Got it? Right. Non-produced, non-financial. The items are clear. Okay, if you guys have anything to clarify, please ask. Okay. You need to know under each account that we talked about, only three main accounts are there, current, capital, financial. Under each, what are the main things we include? We need to know. Okay. Right. Then capital account entries or items. So now I'm giving more detail, right? Entries that we have earlier. The broad categories are given. Right. So as I said earlier also, buying and selling franchises. Can you name some franchise businesses that we have in Sri Lanka where Sri Lankan companies have bought? You have to tell me about two or three. You have to tell me what is the franchise brand and the company in Sri Lanka who has got the franchise. I'm sure in business studies you have learned. Okay, let's see. Ramla Cargill's KFC. Yes, very good. Pizza Hut, Gamma Pizza Craft. Yeah, it used to be John Keel's. Pizza Hut used to be John Keel's. I think now it's they go by a different name, I assume. Right? Cargill's KFC. Yes. McDonald's is done by Abans. Very good. Yes. Yeah. Abans is doing McDonald's. Right. Yeah. Good. So, and then there are not only fast food related, but different franchise agreements can be there, right? Where you get their methodology, you get their products, brand name, logo, everything is given, but you have to pay them a certain percentage of the sales proceeds that you get. Basic understanding is that, right? Burger King is soft logic, yes. Miniso is Avance. Okay, good. Right. Then we have selling land or title of a diplomatic mission. For embassies, you have to sell the land, where they have to own the land on which the embassy is built. Get it? Then buying and selling intellectual property, IP, intellectual property, such as brand names, copyrights, things like that. Entering lease and acquiring licenses, right? Lease agreements and licenses. Then receiving and receiving and not proving, providing. So adjust that. Providing funds on a unilateral basis for purpose of raising capital, right? Okay, funding requirements to raise capital. Then capital grants, development assistance, and donations. This is mainly government, right? Related official, financial or material received by the government from other governments and multilateral organizations, and official debt forgiveness. Now see, this is important to us. Sri Lanka is expecting some of our bilateral lenders. Who are Sri Lanka's bilateral lenders? Bilateral meaning between another government. Who are Sri Lanka's biggest bilateral lenders? Sri Lanka's largest bilateral lenders are whom? Okay. Economic students. Rahmi. Fatima Hafiz. Okay, yeah, okay. Most of you have named, but you're missing a country, Puta, which is also a big blender to us. Mainly, there we go. Ramla, good. Mainly 3 countries. Now India, then China, then Japan. These are our 3 largest bilateral lending countries. Okay. In addition to that, there are other countries. They have formed into a lending kind of a Paris Club is there, right? But mainly bilateral lending is done by them. So we are hoping, based on our situation, that some of these countries, some of the debt, they will forgive. They will just let it go, forgive. So if there is a debt forgiveness, it's considered as an inflow. And where do we record it? In the capital account. In the capital account. Debt forgiveness comes under the capital account. Non-produce, non-financial. Now, someone could ask me, isn't debt financial? Then how does it come under non-financial? No, there it's a donation, transfer. Are we clear? Transfer. So it comes under capital account. Right. So just make sure you're very broad knowledge you need to have about the capital account Bota here. But make sure you're very familiar with this list. Because if the examiner is giving you a double entry based question or another estimation based question, some of these items can be used and they can check whether you know this goes into the capital account. Okay? Right. Then what is the link between the BOP current and capital account balances? The current account balance, the sum of the 4 sub accounts, added to the capital account balance will derive the current and capital account balance. So we get something called the current and capital account balance. Theoretically, it's important. Conceptually, practically it doesn't happen. Theoretically, the balance of the current and capital account should equal the financial account. Get it? So if I say something like this, CAB, current account balance, CAB is current account balance, plus KAB. In economics, in many places, for capital, we use the letter K. So CAB, KAB, current account balance, capital account balance. The total of this should equal the FAB. What is FAB? No, the financial account balance should equal the financial account balance. Theoretically, that is what we are saying. Practically, does it happen? No, because there are possible errors and omissions, and there are things that we need to, we have overlooked. So practically, there might not be this situation. Theoretically, it has to happen. Because the financial account, what it shows is how we have financed the activities we have engaged upon in the current and capital account. Okay? Right. Then the current and capital account balance indicates the economy's net lending or net borrowing situation. So in the financial account, if we have created more liabilities because we have borrowed more, that will be because we have deficits and we have underperformed in the current and capital account. In the financial account, if we have more assets and if we have created less borrowings, less debt, that means that we have performed well in the current and capital account. So our performance of the current and capital account will reflect through the net lending, net borrowing requirements that are shown through the financial account, shown in the financial account. Right. Again, I'm going to ask one more time. Are we clear? The link between current capital account balances and how it connects with the financial account. Is there any question? Basic theoretical knowledge, that's all. You're not going to be tested in depth in international finance. Right. Then financial account of the balance of payment. This is the final of the three accounts we have to talk about. You know the items, three types of investments. Remember, three types of investments. We have direct, portfolio, and other. Two items, derivatives, and then reserve assets. Derivatives and reserve assets. Always try to recall it that way and keep the number of items in mind. Okay, those numbers we talked about. Right. So financial account of the balance of payment. I've given a summary for you. Okay, right. Conceptually, the balance of the financial account, that is the addition of the 5 sub accounts. Shall we say it one more time? What are they? If you can just look at the screen and go with me. 3 types of investments: direct, portfolio, other. 2 items: derivatives, reserve assets. 5 things. You add together, then you get the financial account balance. Should equal the balance of the current and capital. Now, this is the second time we are saying this. So it has really go into your head now, right? Theoretically, conceptually. Right. Then practically though, practically, so this is conceptually, now we are looking at it. Now we are looking at it practically. Okay. The financial account balance adjusted with net errors and omissions tend to equal the current account balance. Otherwise, it doesn't. We have to adjust with the errors and omissions. I've given a small note and explained errors and omissions. So we'll talk about that a bit later. Errors and omissions. Then the financial account and errors and omissions measures how or indicates the manner in which the net borrowings from or net lendings to the non-residents as shown by the status of the status. You guys know all about status, no? Status of the current and capital account balance is being financed. This point is very important. Okay? So it deserves a star. Make sure you focus on that a bit. Okay? So what does the financial account, after adjusting with net errors and omissions, the financial account, what does it show and how does it indicate the outcomes of the current and capital account in terms of net lendings or net borrowings? Net lendings or net borrowings. Okay? Third point, I'm giving a a bit weight, bit of an importance that you guys have to take to your mind. Okay? Yes or no? Right. But this knowledge continues on even in right, eventually in page number 10, right? When we discuss the concept called overall balance for there also this comes back. Okay, right. Financial account, I have illustrated the sub items. It's a bit additional at your level, but my strong recommendation is you read these notes at least once so that you have a bit of a idea, especially when it comes to these items like investments. How do you decide what kind of investment it is? Is it a direct investment? Is it a portfolio investment? Mainly those decisions you have to make. Get it? Especially if you ask to write the double entry and things like that. So therefore, at least the investment items, I would recommend that you read the notes. Everything is very clearly explained. I'll just give you a brief idea. If it's direct investment, right, it's where you have to have more than 10% ownership with voting rights of a Sri Lankan business entity. Of a Sri Lankan business entity. Direct investment. And then I would focus you on this part. The most common form of direct investment is foreign direct investment, FDI, which is essentially the process of creating what assets? Real assets, and engaging in manufacturing and service sector enterprises by foreign private sector businesses. Mostly, this is how MNCs come into the country. What are MNCs? We talked about it on international trade. Under globalization also we mentioned this. What are MNCs? No? What are companies like Unilever's, Nestle's, P&G, Procter & Gamble? No? Pharmaceutical people. HSBC, Standard Chartered. What are these? This I'm asking. What are they? They are? There we go. Multinational corporations. Multinational corporations. Multinational corporations. Right. Okay. So the 10% story is key. Voting rights, more than, right, equity. Portfolio investment. Portfolio investment. Mainly this is done in equity shares, yes, right? And other kinds of debt securities, yes, but here we go. Less than 10% of equity with voting rights. Then we call it what investments? Portfolio investment. Okay? Mostly they get involved through IPOs, initial public offerings. Right. Any questions? No? Yes. Financial derivatives have a basic idea as a concept. You need to know what financial derivatives are. We talk about financial derivatives a bit in money and banking also, right? Mainly the idea is that it's kind of a risk mitigation. It is to reduce the risk of financial investments that we do. It's kind of like an insurance policy on our investments, financial investments, right? There are different derivative products are there, right? Those, of course, it's good to know some of the words: futures contracts, forward contracts, options, swaps. We do, central bank does a lot of currency swaps and all that, and warrants. So know some of those words, right? Basic idea is simple. It's a way to reduce the risk involved in risk associated with changes in the future price of financial assets. Hedging and all those things broadly come under this. Right. Now, don't assume that you have read all of this. I'm just highlighting the key things, requesting you to read. Is that clear? If both are done properly, if both of us do our job properly, it will make a full knowledge in you, complete knowledge in you. Right. Two halves make the full. Right. Financial derivative. Then other investments I've explained, items mainly I'm giving, common items. Right. One of these items we use a lot when we do the double entries, currency and deposits. Right. And this is important. We'll talk about this under the IMF area, special drawing rights. Okay. It's IMF currency. Okay. Just as a helping hand or some input for you, I've given the double entry. If it's SDR, issuing SDR, when IMF issues SDR Sri Lanka, it's a liability in other investments, right? And it's an asset in reserve assets. Okay. Reserve assets, I've given a small explanation here, but separately we learn about reserve assets, especially government reserve assets, official reserve assets. right? Why we need reserve assets, I've explained you the purpose of having such reserve assets. We'll talk about this in a future area also because it's a big, more relevant concept for Sri Lanka now. Okay, this is what we had very limited amount in 2022 around April. That was one of the reasons why we declared bankruptcy. We said we can't pay, we defaulted loans. Right. So hopefully all that is clear. The case for the BOP overall balance. So before we get to the case for the BOP overall balance, let me quickly remind you guys that 5 items are there in the financial account. And it's important that you read and have a basic understanding of these 5 items, especially the direct investment portfolio investment items are important for you to know, right? In the other items, what is relevant, I have given you a guidance now, right? The case for the overall, case of the BOP overall balance. Read this note. It's a very complete and an updated note, I might add, right? So it says, although the sum of, right? Just go through this with me, but although the sum of current account balance, CAB, and capital account balance, KAB, should conceptually or in principle, another way to say is theoretically, equal the balance, financial account balance, FAB, remember? Imbalances may occur. Imbalances may occur. In practice, there's a full stop there for some reason. Anyway, in practice, due to many imperfections of data. Imperfections of data. Okay, we always don't get the accurate information and imperfections of data. This imbalance is known as the net errors and omissions. We enter something in one place, but we don't enter in the other place. Double entry, right? Things like that can happen. Or when we get some data from one authority from the customs, and when we get it from another authority on the same item, the values might not be the same. Likewise, there are many reasons for this to happen. Thus, the net errors and omissions, NEO, is used to balance the current account and the capital account with the financial account to balance it off, right? So theoretically, CAB plus KAB should equal FAB. Practically, CAB plus KAB will equal FAB plus if you do net errors and omissions adjustment. So, the net errors and omissions is then the difference between CAB, KAB balance as a total minus financial account balance equals net errors and omissions. Now, why do we say, now, what was the heading? The heading was the case for BOP overall balance. Why do we need to explain why we need an item called overall balance? Because theoretically, BOP overall balance have to be 0 because of the double entry system. All credits will be cancelled off with the debits and the final outcome has to be 0. So read that part. Theoretically, again, theoretically or conceptually, based on the accounting double entry approach, the BOP outcome should be a 0 balance. Can't have a value because the credit, everything goes to 2 places, credit and debit, they cancel off, so 0. Since the debits shall equal the credits. Therefore, it is generally stated that BOP will always or essentially balance. Balance of payments always will balance. And the outcome will be 0. Again, accordingly, the addition of the current and capital account balance, the net value, and the financial account balance, the net value, right? So CAB plus KAB, and then if you take the FAB, the outcome should equal, when we adjust it with errors and omissions, of course, the outcome will equal 0. The outcome should equal 0, theoretically. Are we clear? There can't be, now this is where I'm coming from. There can't be something called the overall balance. There doesn't need to be an item called the overall balance. Then why do we actually estimate or have something called the overall balance? It is required for prudent, very practical, we'll say very practical macroeconomic management, right? To identify the overall net effect of the transactions between residents and non-residents are beneficial or disadvantageous for the given country's foreign reserve or reserve assets. Because we have an item, reserve assets. So what happens is, when we have a gap between the foreign currency inflow and the foreign currency outflow, and if the outflows are more than the inflows, for example, if the outflows are more than the inflows, we will, with all the errors, omissions, everything we can do, but we will have practically we have a shortage there. So what we do is, we using that reserve assets item, we bring our foreign reserves into the BOP, and we ensure that the financial account will balance and overall the BOP will balance. But it is not where there is no impact on the country. Are you guys clear on the point that I'm making? Practically, when we engage in economic activities with the rest of the world, that is what we record in the BOP. We will come to a certain situation where our inflows of foreign currency are either more or less than our outflows. The example I took was, that is more relevant to Sri Lanka. If our outflows of foreign currency are more than our inflows, we have a gap. Okay, a foreign currency gap is there. So to cover this gap, we will need to come up with a way. So what we do is, in the financial account, the item called reserve assets, we use our foreign reserves or assets to bridge the gap, close the gap between the outflows being more and inflows being less foreign currency. Now, once we do that, and then adjust with the errors and omissions and all that, we will see CAB plus KAB, okay, plus FAB adjusted with net errors and omissions will lead to a zero balance. So then we will look at the BOP statement and say, no problem, no impact, everything has worked nicely, zero balance, job done. But is that the actual case? No. There was some money we took from our foreign reserves and used to balance the BOP, That amount we took from our foreign reserves to balance the BOP represents a considerable economic impact. It could have an impact on many things, and none more important than the impact on the foreign exchange rate. Not only that, many things are affected when our reserves, foreign reserves, especially official foreign reserves, increase and decrease. So there is a macroeconomic management need for us to know, yes, the BOP will balance, but we need to know what is actually happening to our foreign reserves. If you want to know through the economic activities we do with the rest of the world, what is the actual impact on our foreign reserves, for that purpose, we estimate what we call an overall balance. So what does the overall balance show? What is the purpose of the overall balance? To know the impact of our economic activities with the rest of the world on our foreign reserves or foreign assets. Can you guys make a note of that somewhere? Just for your understanding. Just write somewhere here. I'll repeat it now. Just make a note. So maybe you can write something like this. Y BOP OBL balance. Why do we need a BOP overall balance? That is a question. So the simple answer is, okay, to identify the impact, to identify the impact of a country's, Y apostrophe S, of a country's economic activities with the ROW. Country's economic activities with the ROW, with the ROW, okay, with the ROW on the foreign reserves or assets of the country. 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 Right. So there's a request from one of your classmates to repeat. I assume because of a connection lag, right? Okay. So basically, if you ask yourself a question, why do we need to, why BOP overall balance is required, then we could say it is to identify, okay, to identify the impact of a country's economic activities, impact of a country's economic activities with the ROW, with the ROW, with the ROW on foreign reserves or foreign assets, on foreign reserves or foreign assets. Of course, it is for a given period of time, but okay, you get the idea, right? Foreign reserves or foreign assets, foreign reserves or foreign assets, on foreign reserves or foreign assets. Right, done? Okay, right. So then it says, therefore, identifying the item known as BOP overall balance, which indicates the net change in foreign reserves of the country, is important. No argument there. Important. Right. Okay. How do we do this? We can't estimate the BOP overall balance through the BOP statement itself. To do that, we have to separately go out of the BOP and look at a special table, a special statement, and identify something called net international reserve asset position and how it changes. It sounds like a very complicated thing. It is honestly not. But you guys have to, as anything, just pay a bit of attention and focus. Okay? Right. Just read this once very quickly. You have the study material. Just read it once. Okay, right. Now, overall, Bata, we are trying to, as I explained earlier, we are trying to figure out what is the impact of the whatever we did with the BOP or in the BOP process on the foreign reserves or foreign assets of the country. Right. So to get this outcome, we have to have something called the net international reserve assets position. What is the change? Delta meaning change. So to get this, what we do is, right now here, I've used the same abbreviation with a small difference. So it's possible you get confused. Here OB is for overall balance. Get it? Overall balance. Here it's for opening balance. Here closing balance. Right. We take the net reserve asset position at the end of the period minus the net reserve asset position in the beginning of the period. Then we get the difference. The difference is equal to the overall balance. Now the question you guys have to ask is, how do we calculate the net reserve asset position? Net reserve asset position. So that is done based on a small table, right? Which I will be referring to, okay, in the annual report, right? We'll do that now, okay? Because I haven't included the table here because I thought it might be a bit complicated for you guys, right? Because in your, especially for the 2022 period, that is our reference period. For the 2022 period, there is basically some significant changes. So it's important that we just have a look at the bank report so that we get a proper idea, right? So we'll do that in a bit. Okay, we'll look at the bank report and get an idea of the exact situation. Anyway, I'm just looking at the tute. Yeah, foreign assets, of course, the main items and all that I have given, right? So that part is complete. There's nothing to add from the bank report there. Yeah, so since 2020, what has happened to official foreign reserves? We need to have a bit of an idea. Okay, sorry. So what I will do now is, right. Can you guys see the central bank annual report? Yeah, yes or no? Where it says central bank annual report, can you see it? Yep, right. Good for you. Okay. And here we are going to go into external sector. Basically, chapter 5. External sector development and policies. This is the central bank chapters. Okay, don't mix everything up. Right, external sector development and policies. So once I click on that, I will be taken into a PDF, right, where a pictorial kind of a infographic is given, right? Okay. But then we are looking for a specific table, right? We will get to that soon. Hopefully, you will not feel dizzy when you look at this. Yeah, here we go. So okay, if you guys have a calculator or something, small calculation you might need to do. Okay, right. Now, what is this table called? First of all, gross official reserves, total foreign assets, and overall balance. Okay, overall balance. So you find this in, if you have the annual report, the hard copy by some chance at home, you find this in page 184. Okay, page 184. Right. Okay. Now, so the table is clear. Right. First, we need to find net international reserve assets. Item number 7. How do we find item number 7? How do we find item number 7? Can you guys help me? How do we find item number 7? Yes, I'm getting some answers, but very slow response rate, though. Okay, it's explained, but it's very easy. Now, first thing is, you take item number 3 minus 6. What is item number 3? Gross official reserves. How do we get item number 3? 1 plus 2. Government foreign assets, central bank foreign assets. Central bank and the government's foreign assets equal gross official reserves. Official foreign assets. Okay? Gross. Gross meaning it includes liabilities also. So then what we do is we take so item number 3, right? Then we have to minus item 6. What is item 6? Reserve related liabilities. Reserve related liabilities. So you take the gross official reserves and minus the liabilities. Then it becomes net. So that's why we use the word net there. Net international reserves. So net reserves or net assets is assets minus liabilities. Assets minus liabilities. 3 minus 6. Then we get 7, which is net international reserves, NIR. We are looking for the change in that. I'll get to that in a bit. Okay. Yeah, that's okay. Right. Now, let's let's see how to get the balance, BOP, overall balance. So let's figure out how we got this for 2022. Are you guys with me? Go to the last column, 2000, item 8, last column. Item 8, last column. What is the value? Minus 2,806. Minus 2,806. This value here. Okay? Minus 2,806. Yes or no? Right. So follow the cursor right. 2,806. How did we get that? What is the formula you have in your tute? Net reserve asset position, closing balance minus the opening balance. Closing balance. What is the closing balance? Do this calculation for me. 3,299. 3,299. Are you clear? Right. Okay. 3,299. What is that? That is the value for 2022 net international reserves. From that, minus the closing balance. So the opening balance. Opening balance is what we had in 2021. 2021, how much did we have? 423. Get it? 423. When you adjust, how much do we get? Are you guys doing this calculation? What's happening? Okay. So we take the net reserve asset position. Okay. Closing balance. So net reserve assets closing balance so closing balance meaning end of 2022 minus 3,229. From that, we have to minus the opening balance, that is the 423. Right? Are we okay? Yes or no? So we take this table and we do a separate calculation and find out the overall balance. Is that clear with that? Right. What you guys have to know is, apart from 2019, persistently we have had a BOP overall balance deficit. We've had a deficit. And 2021, then 2022. Can you guys see what has happened to our foreign reserves? In 2018, we had official foreign reserves of 5,000. Our net position was 5,495, 2018. From that, in 2019, we have improved it to 5,871 positive values. And then, Buddha, we have ended up with, by 2022, with the crisis and everything, negative 3,299. That means we are in debt. Negative. Our liabilities are more than the assets. Negative 3,209. That's a really perilous, very, very bad situation for the foreign reserves. And look at that top column, top row. See what has happened. The government foreign assets, and then look at item number 2. Look at item number 2, from 6,000, then 7,000. It has come down to 1,858. Drastic drop, drastic reduction in central bank foreign assets. Look at gross official foreign assets from the high point of 7,642, item number 3, 7,642, the highest value by 2019. We have brought it down to, it has eroded to 1,898. Is that clear with the? So all these show the massive impact of that economic crisis, and actually one of the causes of the crisis is our inability to maintain sufficient work reserves, foreign reserves, which also shows that we have done we've had many disadvantages more than advantages when we have dealt with, when we have done economic dealings with, activities with the rest of the world during 2021-22 period. Is that clear? Got it or not? We are okay? Right. So that's the story about the overall balance. Then we come to now. I hope you guys have made the necessary notes. I've explained these things further in page 11. Okay, I've explained these things further in page 11 also, right? But I hope you guys are clear. And when you want to just look at this again, you can always refer to the central bank annual report. Okay, right. With that, I'll go back to the study material now. Yeah. Can you guys see the study material? Yeah. Page 11, where it says noteworthy. Can you see it? Yeah, great. Okay. The net reserve asset position, NRAP, is defined as the difference between reserve asset position, that is the gross official reserves of the government, and the reserve asset related liabilities, CBSL foreign debt position. So that is what where we said 3 minus 6 part, right? Then gross foreign reserves, reserve asset position, is the combination of government foreign assets and central bank foreign assets. That part also we did the 1 plus 2 part, right? Okay. Then I have left some space here actually for, okay, net reserve asset position. Okay, net reserve asset position and BOP overall balance. For, if you can try to get these values, take 2018, okay, or yeah, 2018, 2019 as the pre-crisis, the comparison before the crisis, and then take 2021 and especially 2022 after the crisis, and take the numbers and compare. You will see what the trend. Okay, right. Then we go into the double entry approach. Right, I'm going to make this very simple, right? Identify the first entry. Identify the first entry. Yeah, I'll give you the guidance, but I want you guys to attempt this though. So I might decide to check the double entries with you next week or in the next session. Okay, I really feel that you need to do this. Otherwise, just copying down what I give is not enough. Okay, the application part. Yeah, application exercise 1 and 2. I will give you the guidance, but I want you to do them, and then I will check them next week while we can move on. Okay, right. Here is the basic idea of that. We follow 2 steps when we write the double entry. First step is we have to write the first entry. Now in accounting, what is the tradition? What do you write first? The debit entry or the credit entry in accounting? Yeah, if I'm not mistaken, you indent and write one entry. No? Counting? Yes, you write the debit entry first. In economics, in marking schemes or wherever these things are given, we don't seem to follow that rule. Okay, so my concept for you is the first entry could be the credit entry or the debit entry. Doesn't matter. Figure out what should the first entry be. Because the second entry always, it could be, second entry could be the credit entry or the debit entry. It always goes to the same place. It always goes to the same place. Get it? Right. So the first entry could be credit or the debit entry. To figure it out, the basic guidance is simple. If it's an inflow, example, if it's exports, receipts of some money, or receipts of some kind of payment we are getting, receipts, or disposal of non-produced, non-financial asset. So it could be a good service or asset. If it's an inflow, then it's a credit entry. If it's an outflow, it could be imports, payments, acquisitions of goods, services, assets. If it's an outflow, debit. That's it. So the first entry could be credit or debit, doesn't matter, but you have to figure it out. Okay? Secondly, the second entry will simply go to the financial account, other investments. If you want to write a subcategory, currency and deposits. Currency and deposits. It could be the second entry could be the credit entry, second entry could be the debit entry. That doesn't matter, but it always goes to the same place. Okay. Now, in the first step, in the first entry, you not only have to figure out whether it's a credit or a debit. You not only have to figure out whether it's a credit or a debit. You need to figure out what is the main account and what is the sub account or item. Is that clear? You figure out what is the main account, what is the sub account or item as well. But the way you write the double entry, it's very simple. Step 1, step 2. Got it? Once you do a few, you will be okay. So I'm going to do the first one with you guys to give you a guidance, right? And others I'll read and just give you an idea, but I want you to attempt. Okay, shall we try the first one? Read it and tell me the first entry and then the second entry. Yeah, I think I reminded you guys sufficiently, and I made a request also for you to help me with your friends who are not committed to this, maybe. But if you don't have the hard copy of the study material, but you know the process to get it. Okay. Make sure that you have made the payments, you have an order number, then give that order number to the coordinator when you come for physical classes, or if you're a virtual student, you through WhatsApp, you can communicate your order number and things like that, and then make sure you get the material. Got it? Very simple. Right. I think this is the first one. Yeah. A Sri Lankan tea plantation company exports 10 million US dollars worth of tea to a supermarket chain in Australia. We'll say Dilma or someone. Right. So how does it work? What are the what is the first entry? Is it a credit entry, debit entry? What is the second entry? So Sri Lankan tea plantation company exports. So you pick that, no? Exports. So exports meaning it's a inflow. Inflow kiyanne credit. So the first entry is a credit entry. Okay, inflow. But tea. We are exporting tea. Tea is good. Good meaning trade. What account? Trade account. So goods account, trade account, inflow, credit. That's it. You have figured it out. Now how do we write it? Current accounts, trade account. If you want within brackets exports, credit. If you want to put the value. If not, it's okay. 10 million US dollars. Then, oops, sorry. Then second entry. Now, if the first entry is credit, second entry is obviously debit, and it goes to the same place. What is that? Financial accounts, currency and deposits account, debit, 10 million. Any questions? Are you guys with me? No? Any questions? Clear how we figure it out? Yes or no? If you want to, I can help you with one more. For the rest, I want you to do it. Okay? Shall we do one more? Okay, second one. Interest payments of 250 million US dollars by Sri Lanka as a part of annual foreign debt servicing payment. We have taken loans, now we are paying the interest. Where do we record it? What is this all about? Is this a inflow, outflow? Inflow or outflow? Outflow, very good. Yes or no? We are paying to the outflow, yes. So it's a outflow, that's clear. So outflow kiyanne debit, outflow. Yes, that's clear. Then what is this item about? It's about interest. Compensation of employees, CE, IPD, interest. Interest, which account? Primary income account. What account? Primary income account. Done. That's it. Current account, primary income account. I just want to highlight the primary income part. Debit. How much? 250 million USD. And then second entry, same place. Financial account, currency and deposits, credit. 250 million USD. Done? So I've done two with you, where in the first one, the first entry is credit, second one, first entry is debit. Okay? So read the others, give it your best attempt to figure out the double entry. Okay, use the knowledge you have gathered now. Right. Then I want you to come to page, especially I'm interested in how you guys tackle situation 4. Okay. Then situation 5, interesting to see how you guys tackle. Then, and yes, situation 7. So I said 4, 5 and 7. Not that the others are not important, but these are, I'm interested to know how you do this, right? Okay. Application exercise 2. I'm going to give a guidance so that you can practice this and apply yourself. We'll check the answers definitely by next week. I have the answers done up already. Right. Application exercise number 2. Okay. The transactions of the balance of payment of hypothetical economy are given in the table below. All figures are in rupees billions. Right? Figures are given in rupees billions. Right. You are given the credit and the debit entries for several items. Merchandise, compensation of employees, financial services, dividends, air transport, government transfers, sea transport, interest income, worker remittances, travel, telecommunication, non-monetary gold. 2 requirements: BOP current account balance, show all sub-account balances separately. You have to do it and get the answer. Then the net export value. Net export value. Got it? Right. So what you have to do as a format, I would say, now you guys get what you have to do, right? Credit minus debit. You get the net value. Could be a positive, could be a negative. What do we do? Credit minus debit. Inflow minus outflow. That's all you have to know. Inflow minus outflow. Get it? So for each thing, credit minus debit. And then BOP current account balance. Are we okay? Right. Then in terms of format, I would say, so start with the trade account. Okay. See if you have, now you are given merchandise goods. In addition to that, is there anything that has to come into the trade account? Merchandise goods, 800 minus 1200 you can take, right? In addition to that, is there anything that should come into the trade account, goods account? Yes or no? In addition to merchandise goods, is there anything else that should come to the trade account? Yes, what should it be? What should be there in the trade account in addition to merchandise? Amani, Akila, Mehna, I think I said your name correctly. Ilma, yes. Lakshika, yes. Very good. Yeah. Yeah. Fatima, yeah, correct. Right. So, Rahmi, no. Goods, merchandise, trade. Go back to the notes. Read and apply. That's all you have to do. Get it? Yes, Noha, correct. So most of you are getting it. I didn't say it out loud, but likewise, account by account, figure out whether you have taken everything relevant and do the calculations. Get it? Ajay, no. Think. We have learned Buddha. We have learned no trade account separately, right? Then you know what are the items that comes under the trade account. So take those items, get the values. Then services account. Take the relevant item, get the service account balance. Likewise, separately estimate primary income, then go for secondary income, right? Secondary income. I'm giving a very rough thing. Take all the items and then you get the CAB, current account balance. Get it? No. No, but right? Don't guesstimate. Go back and learn the thing or go through the notes properly and then apply with confidence. Okay? That's the best thing to do. Right? And remember, trade account only includes visible, tangible things. Services account only includes intangible, non-factor based services. Primary income includes basically primary resources, but we consider mainly compensation of employees under the condition we take that it has to be residents, right? And then we take IPD. So we have learned. So when you do a question, the objective is to apply your knowledge. Okay? Right. I'm sure you guys will get this done properly. I'm confident that there wouldn't be an issue. Yeah, for now, when you are given the credits and the debits with that is what I noted here. At this point, I have noted inflows minus outflows. Credits are inflows, debits are outflows. That's how we get a balance, no? So yes, for each of these, credit minus debit. Get it? I think I answered your question. Right. So do those. Then we come to a bit of an important area. Sri Lanka as a country, we have had rather bad experience with the balance of payment, especially the current account, especially the trade account. And we have long-term BOP deficit situations. Difficulties are there. So we have to do many BOP, not financing, but adjustments themselves. BOP reforms, adjustments we have to do. So what are these BOP adjustments that we have to do? The first one I have given as the first one because it is one of the main things we have to do. What is that? And before I forget, you guys need to get some data from the bank report. Okay. So overall balance we have covered already. But in addition to that, I'll just give a guidance here. For 2000 and yeah, 2019, 21, 22. Okay. If these values you can't find, that's okay. You should be, but if you can't, that's okay. But mainly focus on 22. I want the trade account. Okay, trade account balance, what has happened, right? And if possible, percentage of GDP is also good, but mainly the balance. Okay, then the current account. Okay, you can find this on the bank report, chapter 5. Are we okay there? Quickly. Okay, done. Right. Then, so first thing is we have to understand we have a real problem. It's a considerable risk that we are facing, that we have a very um, uh, kind of very limited areas that we are specialized in when it comes to exports. We are mainly tea people, garments people, spices people. Beyond that, we are not big in any other area, any other export sector. So that shows we have a significant lack of diversification. Significant lack of diversification. Okay, significant lack of diversification. Are we clear? So one of the first things we have to do is, this takes a bit of time, you can't do it overnight, but we have to have a campaign, a proper program for export diversification. Go into many different potential areas where we can do well, we can be efficient, we can gain, we can have good margins and be competitive in terms of exports. Export diversification. Okay. So there we can look at not only goods, we can especially go into services sector, tourism related. There's a lot we can do in terms of diversification. Okay. Got it? So then, promoting and encouraging traditional exports. Okay, promoting and encouraging traditional. Now, sometimes when we keep talking about diversification, we get a bit carried away and we ignore the already established brand names we have like Ceylon tea and Sri Lankan apparels and all that. We are not saying to our spices the kind of a recognition we have in the world. We are not saying to ignore those for them. We are saying while protecting them, while developing them, go into new areas. So both I have given export diversification, that is the new areas, and this is to make sure that traditional things are protected as well. Got it? Done? Then promoting and encouraging establishing, so let me mark that otherwise, right? Establishing export promotion zones or areas. Export promotion zones or areas. Export promotion zones. So now I'm now trying to think. Okay, in Sri Lanka, Putta, we have identified different parts of Sri Lanka, right? In Katunayaka, we have Biyagama, we have Sitawaka, Visavella, we have in Koggala, we have in Hambantota, we have. We've identified these areas and we have developed them with all the infrastructure, all the facilities into export promotion zones where certain tax benefits are given. As I said earlier, the facilities, infrastructure is given, right? And all the other ancillary services they need are in one place. This is to reduce cost and make production more efficient, targeting not the Sri Lankan market but the export market. So we can establish more export promotion zones as well. Entering trade agreements with foreign countries. We talked about trade agreements and how they can promote trade. Of course, there can be trade diversion and trade promotion, both trade creation, both can happen. Promoting and developing import substitution industries. So that's a bit of a concept we are trying to follow. Import substitution industries. Feels like I cancelled it off, cut it off. Import substitution industries. That is, whatever we can produce within Sri Lanka, rather than importing, if it's economically viable, if it makes sense to produce those goods within the country, Then implementing measures to discourage all non-essential import goods, protectionist policies. Yeah, that is what we did with the pandemic and with the economic crisis. We put many things in a list and said these things we can't import because they are non-essential. Controlling domestic inflation, that's a big thing. Now, why we tend to import a lot is, or why we are motivated to import a lot is, because when domestic inflation rates are high, anything produced within Sri Lanka is expensive. So natural logical thinking dictates, or logical thinking says, import it from another country where it is cheaper. Get it? That's very logical, rational behavior. But it has a big impact on the balance of payment, the foreign currency inflow outflow situation. On the other hand, with inflation, our international competitiveness also will decrease because our cost of production increases. Get it? So everything we export will become expensive and our competitiveness will fall, reduce. Right. Next, permitting a depreciation Now, this is carefully done and very carefully you have to do it. Sri Lanka has tried this. It has not worked that much because what we import, we realize is highly inelastic. So normally what happens is, when you allow the currency to depreciate or you purposefully devalue your currency, what happens is imports become expensive. So we assume imports will decrease. And whatever we export becomes cheaper to the rest of the world. So we believe exports will increase. But in Sri Lanka, imports decrease, but not as much as we want. So what we end up doing is, are you guys listening to me? What we end up doing is, right? What we end up doing is, we import slightly less, but at a very high price. So we are actually, because of the depreciation of the currency or the devaluation of the currency, we are spending more foreign currency on imports than we used to before the depreciation. So the objective is not achieved. The objective is of a depreciation or devaluation is to, where imports becomes expensive, we give up on the imports and we use domestic substitutes, or we drastically reduce imports. Unfortunately, in Sri Lanka, the import quantities, our imports are inelastic. Our import demand is inelastic. What does inelastic mean? Come on, these are bread and butter for you guys, no? Inelastic means when price changes, quantity demanded changes less. So what we import, we slightly reduce, but we still import the same amount, same quantity. Is that clear? So on the other hand, exports, what we export now, why is our imports inelastic? We will learn in the foreign exchange rate area, but mainly we import petroleum-based products, certain food items, certain medicines, certain machinery equipments, other raw materials. All of these are essential for us. So demand is inelastic. Export side, most of the things we export are not that essential for the world. So when our exports become expensive, quickly the demand reduces for our exports. So our export earnings fall, import expenditure increases. So depreciation, devaluation has not given us those expected results when we have tried this in the past. That's why it's a last point, last result. Got it? Right. So these are the policy adjustments we can take to overcome long-term BOP imbalances, especially current and trade account deficits. Okay, now recently we were talking about after many years, after so many decades, Sri Lanka was able to get a BOP current account surplus, right? So the reason for that is, or what we are saying there is, okay, okay, I'm just trying to show you the balance of payment a bit. So here we have the current account. Okay, can you see our current account? Now don't get confused with these bigger values and all of a sudden smaller values situation. You can see credits, debits, net. We'll go for the US dollar thing. Okay, 2022. Okay, current account from a deficit of, okay, from a deficit of 3,000 here. Okay, from a deficit of 3,000 284 in 2021, our deficit has reduced to 1,453. Our deficit has reduced to 1,453 by 2022. So 2022, we did more worse than 21 as an economy, but our deficit has reduced. The reason is we restricted so many imports, and when the dollar became so much depreciated, our exports, our importing ability reduced further. So all these things together, it shows that our current account is doing okay. Not a surplus, but doing okay, right? So if you take the trade account, goods account, also you see from 6,552, it has reduced half, almost half, or more than half, to 3,075. So those reductions are result of strict import controls. But the problem is when we control imports a lot, what do we import? Most of the time we import intermediate goods. Most of the time we import the machinery, equipment, the raw materials and other stuff we need, petroleum products that we need. So that means economy is shrinking. Economy is shrinking, right? So that's that. So let's talk a bit about the foreign assets situation, right? Some basic concepts you guys have to know. That's the requirement, okay? Page 15. Foreign assets. So I have given a definition as per this International Monetary Fund balance of payment 6 edition. They define reserve assets as those external assets that are readily available to and controlled by the monetary authority. So that means central bank for meeting balance of payment financing needs, for intervention in the exchange markets to affect the currency exchange rate, and for other related purposes. So that is what we call foreign assets or reserve assets. That we can't change the definition. That is the definition given by the IMF. Okay, right. So then generally, so within the definition, the purposes of having reserve assets are also mentioned, right? General foreign assets related concepts are, you need to be familiar with total gross foreign assets, gross official foreign assets. Then we have to learn how to calculate the net official also. Gross private foreign assets, then you have to learn how to calculate the net private also. And so I've just said net is what? Assets minus liabilities. Assets minus liabilities. Main types of assets. So there's a list here. So we have, I've taken this from the central bank annual report. For 22, I've left the column, right? I don't want you to fill everything, but the main items, I would like it if you can come up with, okay? Right, reserve assets, obviously that value you have to find and write, okay? You might know already with what we did earlier. Special drawing, monetary gold, you know how much we have. Remember, I explained monetary gold, right? Gold reserves that the central bank has. Reserve position. Now, sometimes those gold reserves are kept at the Central Bank of Sri Lanka itself. If not, Bank of England, they tend to hold many gold deposits in their vault in the basement of Bank of England for other countries also, right? Then reserve position at the IMF, right? Special drawing rights. Then other reserve assets, currency and deposits. This is important item, currency and deposits. Make a note with us, so just mark that so that you can fill those values, right? Claims and monetary authorities, claims on others, debt securities, right? Okay, so these main things, if you know for 2022, that is good enough. I like to give you these points in a more exam relevant way because this is the central bank's description, right? But before we go to that, it says at present, the main currency composition of these reserves are held in Mainly, we keep most of our reserves in US dollars. Then we go for sterling pounds and then euros. Right? But these days, sometimes we kept in Indian rupees also and sometimes in Chinese yuans as well. Okay? Right. So this is a bit more easier way to remember, right? Official, okay? Official foreign assets or reserve assets. Monetary gold, foreign exchange, foreign currency, we have foreign exchange reserves, cash reserves, special drawing rights, reserve position with the IMF. These two things are both IMF related, right? These two IMF related. Then marketable securities denominated in foreign currency, US dollar securities, whatever we have invested in, right? As a country, that's our foreign part of our foreign assets. Then foreign currency loans that we have given. So you understand in Sri Lanka, these two things are very low, right? Okay. So this is a better way for you to remember the official foreign reserve assets or reserve asset items. Reserve asset items, right? Then let's explore the general concepts briefly. First, total gross foreign assets. They are who are the holders of these foreign assets. Gross meaning including liabilities before minusing liabilities, right? Who holds them? Central bank, central government, and deposit-taking institutions with the central bank's way of saying it, simply LCBs. Three parties, LCBs, total gross foreign assets. Official, okay, so that means for the gross, total gross includes the government plus the what sector? Private sector. Here, only the government or the central bank. Get it? Right. Again, gross, so including liabilities, liquid foreign assets, where is this? Central Bank of Sri Lanka and the central government only. Private, only LCBs. Are we clear? All gross. Right. Then the concept links are very easy. Some of the values I have given for you to go through, right? And I want you to see how the reserves have continuously declined. 2018 to 19, there's an increase. After that, continuous decline to very low values, right? How do I calculate total gross foreign assets? I take the gross foreign assets, official, private, then I get total gross. Get it? How do I calculate total gross official only? Then I take basically the total gross value, and minus the private sector. Then I get the official. Vice versa. Gross private, how do I calculate? I take the total gross minus official. Simple as that. It's the formulas here and there. Right. Net values. How do I get the net value? I take the gross official value, gross official, minus the liabilities, official liabilities, then I get net official. I take the gross private minus the liabilities, private liabilities, I will get net private. I will get net private. Simple concept. Just know the links. Okay? Right. Then the importance of foreign reserves, or reserve assets. Why do we need? Why should a country maintain foreign reserves? There are many very critical reasons, and this can be pretty much a question in the exam, a very possible question in the exam. Then you need to know when reserve assets increase, decrease, what are the economic impact, what are the consequences, implications. Right? General importance is given. Then for an increase and a decrease also I have given. Right? This is an additional area. A bit connected because one of the ways we get foreign reserves into the countries through direct investments. That's why I've talked about it here. Right. So what I want you guys to do is go through this, right? Okay. Go through the importance or the points I've given for the importance of reserve assets as the step 3. Okay. Step 1 here. Okay. Step 1. Step 1. Then do step 2 here. And then go and look at the importance. It will be a overall you're taking the main point. Get it? Appreciation improves or stabilizes the external value of domestic currency. The rupee becomes stronger as a currency because we have reserves to back it up. We have what to back it up? Reserves to back it up. Increase in money supply, because when the reserve assets of the central bank increase when the asset side of the central bank balance sheet increases, equal to that, they will have to increase the liability side. That means they'll have to, there will be an expansion in the money supply. They will print new coins and notes. That's called high powered money. We learn in money and banking. But money supply tends to increase. Possibility is there. Increase in the requirement for foreign loans and increase attractiveness for foreign. Hold on. Yeah, these two words have to change. Okay, there's an error. This is decrease. This is increase. Just third point in both. Appreciation should be decrease and depreciation should be increase. Yeah, right. Should be okay. So when we have enough reserves, we don't need to borrow that much to fulfill our reserves. No? So borrowing requirements decrease, debt burden decreases. On the other hand, as a country, we become more attractive for investment because stable exchange rate, stable economy is always attractive. Improvement in the import feasibility of the country. We can bring down more goods and we can pay for our imports using our reserves for a longer period of time. I'll talk about that in a bit also. Improve in the next area. Improves the macroeconomic fundamentals and promotes economic growth. Okay, macroeconomic fundamentals and promotes economic growth. Gives us a bit of stability again. Improves the credit worthiness and sovereign credit ratings. Those ratings we get as a country, they will come to a good level, positive level. Right now they are junk status, very negative. No one gives us loan because we have very bad credit rating. So deterioration, then if you're smart, once you know the points for appreciation, you can simply reverse them for deterioration. So go through them, it will make sense. Get it? Once you have done step 1 and step 2, then go and look at the overall points. You should be okay. Is that clear? Understood? I said the link between foreign direct investments. No, you saw that earlier also. So I'm giving why is it important for us to attract foreign direct investments? Because one of the ways we can get foreign currency into the countries through foreign direct investments. Not to mention the other benefits like employment creation, new technology flowing in, knowledge sharing is happening, management methods come in, more innovative methods of production are brought into the country. Overall, we will be able to improve our capital stock or the base of the country. Those kinds of things are benefits as well. Right. Measuring the adequacy of reserve assets. How do we know whether we have enough foreign reserves? How much is enough? Basically, the measurement for this is called, right? Measurement for this is called, we look at it, how many months of imports for goods and maybe for goods and services, how many months of imports can we pay using our foreign reserves? How many months can we pay our import bill, import cost only using our foreign reserves? So normally we say for a stable economy, at least 6 months worth of import feasibility, 6 months worth of importing ability should be there in terms of what reserves, foreign reserves. Okay, it's a small concept, so I'll quickly do that and then we'll think about the conclusion of the session. Okay, right. Okay. Right. Can you guys write these formulas, please? These two. And the stats also, if you can make a note, 2022, you have to write. You can find it from the bank report. Definitely, it's not difficult. So first we look at import feasibility of gross official assets. Okay, gross before minusing liabilities, and official, central bank and the government. Right, so gross official assets divided by the import expenditure annual. So we had about 4.6 months of import feasibility in 2019. It has come down to 1.8 in 2021 and further reduction in 2022. Okay. Then import feasibility of total foreign asset, that is government and private sector. We had 6.4 months in 2020 and that has come down to 3.6 and much further reduction would be there in 2022. Okay, find the 2022 value. These are important. Right, get this done. Are we okay? Done? Yes? Right. So with that, I think it's a good place to conclude the session today. Then next week we can look at those answers you have done for the two exercises. And then foreign resource gap. With that, Pata, we are ready to start foreign exchange rates. Okay? Got it? Right. So with that, we'll conclude today's session. The first session for Unit 10. Okay, International Finance. So I'll see you guys next week for session 2.